of selling when the market is going down and buying back securities when the market is going up?
That's a great question. This is the key for what we're talking about here today. That's something that I actually hear often from my clients after they've seen either their 401k or even their IRAs that we manage at Schwab lose value. The hard part to remember is that in most cases, if you're well diversified and we picked good assets and hopefully we bought them at a reasonable price, that drop in value is going to be temporary. Then there's a difference between temporary loss of capital and permanent loss of capital. Permanent loss of capital could be a result of buying an asset too expensive and that asset taking 20 years or more to get back to the price that you bought it at. We saw a lot of this in the late 90s, and we could be seeing more of this now and going forward. Another reason people suffer from permanent loss of capital is because of the emotions, like we talked about today, either being too aggressive relative to their risk tolerance, maybe not having a advisor or somebody to give them a pep talk when they need one, to remind them that this too shall pass. The problem, and probably the key word in that question, was the word going up and going down. Problem is we don't know what a stock or the market as a whole is going to do tomorrow or next week or even next year. And so this is hard to stay invested in many cases, especially when our life savings is on the line, and especially after we're retired and our cash flow is dependent on the value of these assets. So first, we need to be diversified and not have all our money in stocks. Usually, it's going to help to give us other areas to pull from when our stocks inevitably are down in price and maybe priced at less than they're actually worth in the long run. And if anything, we would actually probably, after the market has gone down, if nothing has fundamentally changed about the holdings that we have, other than now it's cheaper, we might want to actually buy more of it after it's gone down. But this is very difficult to do. This is one area where rebalancing a portfolio periodically could help us to take advantage of good prices in the market, and then also capitalize on some of our gains after our assets, especially our stocks, have appreciated in value. But it just goes back to the emotions that oftentimes drive us to a decision-making process that is counter or opposite to what is in our long-term best interests, which is trying to time the market, trying to predict when the bottom of the market is or when the top of the market is, when we would recommend just buying great assets, great companies, great businesses, and never overpaying for those businesses, always trying to find them at a reasonable price when we can, or what is called value investing specifically. I'd encourage that person to call in and schedule a one-on-one conversation so we can talk about their situation and just make sure that they are appropriately allocated relative to their goals for retirement.